Good morning. Morning, everybody. Morning, Cab. Morning, Pete. Morning, Steve, Bob, Braun. Good to have you guys. Exalted Sultan. That's me. That's what my grandmother called me. How's everyone doing today? Feeling good? Ready to go? Kick it in like a dope house? Hey, good morning, Jerry. It's great to see you. Good morning, Erla. Excuse me. All right, guys. Let's do what we do so well and check that news, right? 8:30 a.m. Thursday, March 27th. We had some high impact news. I even posted in the room. Hey guys, red news in 5 minutes. I don't know what the S&P did, but the Nasdaq was not much of a reaction to this one. But it always could be, and that's why we check news. Is we're just making sure we don't step in front of that freight train of emotion. Okay. Not much. 10 a.m. we do have medium impact news, which in my own personal life, I'll give you a little heads up on how I do it. When I look at news, I'm looking for red boxes and I'm looking for orange boxes. Red boxes, the response to high, impact news can be so aggressive, I don't want to be in a position. Most prop firms forbid trading during high impact news. It's that volatile. The medium impact news, my thought process, I want to protect my position, but typically won't exit prior. So if I'm already in a position, medium impact news, a lot of times I'll hold it. I'll make sure that I'm break even plus a few in case of slippage. And I don't even look at what it is. I don't look that it's the GDP or the goods trade balance or anything. Hey, Luciano. I'm looking at high and medium, and I understand that there's an impact that these can create on the market that can make it very untradeable. It can make it spike and bounce. So it's kind of a cool segue because everything that we talk about in this room revolves around advantages. Day trading successfully revolves around having an edge. And if there's an event that could remove your edge through volatility, through indecision, through spiking and aggressiveness, it makes sense to maintain your edge by not being a part of it. So every morning I go to forexfactory.com/calendar and I'm checking news. And again, I never even look right of the boxes. All I need to know is that it's happening, and that's good enough for me. The Nexgen software services page, guys. This is where everything is. Everything you need lives on this page. From the education tab, there's the trading guide, there's the software guide. Your software guide is kind of your Ninja Trader how-to. If you're relatively new, you're trying to work through some Ninja Trader stuff, maybe it's setting up stops, targets, you want to go beyond the provided ones that Nexgen gives you, all of your answers are in there. And then when we talk about trading, all of the answers are here in the trading plan. And I'm gonna say something here. These aren't every possible scenario with the software. That's unrealistic because what happens is everybody in this room is going to grow from a foundation, and you're going to find your groove. You're going to find the way the software speaks to you. You're going to begin to recognize patterns that resonate. The fastest way to find your way is through what we call a high probability trade, guys, and specifically a high probability trend trade. When you look at the trading plan, this is your high probability trend trade broken down. This is what we're going to talk about, guys, and we're going to talk about it because this is a trade that when you follow the rules, typically wins 70 to 80% of the time. And unless your management is just absolutely horrible, it's hard to not be successful on 70 to 80% winners. There's a saying that says the memory or confidence is the memory of success. So the more you win, the more you get paid, the more success you have, the more confident you become. And when you become confident in a trading plan, and your trading plan revolves around having an edge, you're more likely to patiently wait for that edge to be present. Which takes us to the final thing that this trade does for you guys. It teaches you to read your indicators. It teaches you to recognize advantages. It teaches you to identify those edges. And you'll find that about 90% of your day, 90% of the overall process is just reading indicators. It's reading your charts and saying, do I have what I need to take a trade? Do I have an edge? Is this my pattern? 10% of your day will be actually being active in the market. So I tell people, I said, if you spend 6 hours in front of your computer waiting for trades, trying to be a day trader, you're likely to be active about 36 minutes in the market. This morning, I think I took 2 entries when I was in front of my computer. I took 2 entries. Neither of them went the distance. But I was probably in the market for a total of 45 seconds. Still up money, but it doesn't take long to be in the market. So realize that it's not a matter of staying busy. It's having an edge. An edge is where the success tends to come from. Once you can read your charts, once you're comfortable looking at your indicators and hearing the message that they're telling you, you're going to understand the 3 concepts, guys. Where the market is likely to continue. You're going to use this for your entries for the high probability trend trade. You're going to understand where the market is likely to go. This is going to help you with profit taking. It's also, by understanding where the market is likely to go, the other side of that is understanding where the market should not go. And you'll put that one in there as well, and that's going to be used in management. And then finally, you'll understand where the market is likely to stop. These are what we call termination conditions. You'll be able to see these before the market ever reaches them. You'll have a recipe to identify them to keep you from taking trades into areas that could potentially reverse the market. And all of this is just a result of chart reading. So my goal, because my mentor was the smartest man I know. My mentor was the guy that when he teaches you, it feels like Einstein teaching string theory to 3rd graders. John Novak is brilliant, and he's very, very data-driven. I'm very artsy-fartsy, guys. I'm very visual, very right-brained. So a lot of what I do is taking this concept and making it as simple as I know how and giving you guys the absolute basics so that you can have the clearest path to getting to where you want to be as soon as possible. And 3 rules is as simple as it gets. And that's what the high probability trend trade is. It's only 3 rules, and each rule provides an advantage. So when rule number 1 is met, you'll have the advantage of momentum. And when rule number 2 is met, you're going to have the advantage of a clear path. And when rule number 3 is met, you will have defined your entry area. So a trade for the brand new user, it's a little equation here. A trade equals momentum plus a clear path plus an entry area. Momentum and clear path. These are your 2. These are your foundation. When you understand momentum and path, trading becomes a lot easier. When you can identify a market that's difficult to stop, when you can recognize there's nothing in the way, these 2 advantages are enough to build a trading plan without ever learning how to take a high probability trend trade entry. I've seen it. So focus on understanding these 2. Ask a million questions until they're second nature. And then, although the first entry is the high probability trend trade entry, you'll find your entries based on your understanding of momentum and path. These 3 rules happen on only 2 charts. Again, simplicity is few moving parts as possible. So there's a large chart and a small chart. And a large chart will define the direction of the market and let you know which way you should be looking for your rules to be met. It will define the momentum in the market. You'll be able to establish that on the most current first printing bar, and that's going to make sure that rule number 1 is in play. And it also defines the areas. It's going to show you the areas that may be problematic, the areas that need to clear, the areas that could create a bounce. And again, on the most current bar, typically, you're going to be able to establish rule number 2 is true. When rules 1 and 2 are true, you'll turn your attention to a smaller, faster chart. This large chart is a very broad stroke of a brush. It's a slow-moving chart, and it's hard to see change on. Your small chart will break down that 1 bar that gives you all that amazing information, and you'll see retracements, and you'll see pushes down and pushes up, and you'll even see tiny little fluctuations within a bar. And we're going to use this refinement chart, this small chart, this entry chart, and you're going to pinpoint the best of the best spot for entry. You're going to be able to identify exactly where the trend is most likely to continue. And by using the smaller chart, you're going to be able to reduce risk a lot, and you're going to be able to increase profit potential because it's going to put you into the market at the furthest point from your potential target. So rule number 3 is a small chart rule, and rule number 3 should only be addressed when your large chart has told you to go looking for an entry. We use these 2 charts, feeling really mellow today, can you tell? Using these 2 charts, they're a reflection of the forces that you're trading with or against. It's a great metaphor. Your large chart is a large crowd. Your large chart are the men and women with the money and the influence to establish trends and create momentum. And these are the same people that are going to react at those areas on the large chart. And by allowing them to lead the way, you're going to realize that the large crowd typically wins more often than they do not. And your small chart is a small crowd. And they still have a lot of money, and they still have a lot of ability to push the market, to create problems. Little pushbacks and retracements. But here's kind of the magic of rule number 3 on that small chart. Is this small crowd, while they have the ability to create retracements, little pushes counter to everything the large crowd wants, they typically fail 70 to 80% of the time. Which means that by using rule number 3 for entry, when the large chart says go find that entry, guys, you're pinpointing exactly where the small crowd's failure is most likely to happen. And that happens to be the place where the market is most likely to bounce and continue with the trend. So large chart, small chart. Know who you're trading with or who you're trading against. And then we're going to go through my little repetition creates recognition phase. There is a step-by-step path to becoming a confident trader ASAP, because that's what we want. Nobody wants to flounder. Simplicity typically pays dividends, guys. So we're going to take the first hour of class, and we're going to learn the trigger line and Fibonacci rules for when it's okay to trade. And it's okay to trade when the rules are met, because you have an edge, because your rules are literally a description of a pattern that occurs in the market, and those rules describe the advantages that the pattern gives you. And when you take a trade based on that pattern, when those rules are true, you put yourself in a position, give yourself the potential to win up to 70 to 80% of the time. So as you learn these rules, you can practice them, you can simulate. There is zero threat of loss. You can't lose your home and your car and your wife because you had a bad simulator day. Simulator's the driving range and the batting cages, and it's where you're going to build that muscle memory so that when it's time to perform, you've been practicing exactly like you want to perform. So the first step in becoming a confident trader ASAP is post your pictures in the class until you're sure you have the correct rules. But even more specifically, post your pictures in class until you're sure that you're reading your indicators correctly. And the hope is that you don't practice the wrong trades. I know this breaks every rule, but I hope it makes money, guys, because the market, especially on simulator, is going to allow you those lucky wins. And then the second you go live, it's going to strip you of that luck. I've watched it 100 times, and simulator millionaires are what we call these people. But when they go live, they're typically blown out quickly. So practice, 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 and post in the room every time you take a trade. Drop it in the room. Let me open up this picture. Where did it go? I lost my pictures. Hold on just one second. There we go. Every time you post in the room, there's the way to get the best feedback. So I'm going to give you guys this one. How to annotate for the best feedback, guys. Every time you take a trade, or you see something that you don't understand, or you have a question that has something to do with a live market, snap a picture of it and drop it in the room. Use the screencast link, or just copy paste it in. But if you take the time on whatever you post in the room to identify those three advantages that we're going to study. If you talk about momentum, path, and entry on every chart, what it's going to do is it's going to let me know how you're reading your indicators. And if there's something that I can do to help you to read them more effectively, more efficiently, more accurately, then we'll have that conversation right in the moment. It's like a private session with me. And this is what we do in the second half of class. And the other thing about that is when you write the whys, I took this trade because of strong triggers, because that area had the potential to break, and because I had the perfect low risk entry in an area inside of triggers. What you're doing is you're writing the recipe for your future your success. You're literally describing through your rules the pattern that wins more than it loses. So take the time to post in the room, but more importantly, take the time to tell me what you see. I think the first picture that we look at today is going to be an opportunity not to take the perfect trade, but a little insight on how to manage it, to take smaller losses. So that's what you're going to get every time. Oh, can you guys give me a Y if you can hear me, please? Is it just Ron? No sound? Some can, some can't. I'll reboot my end. Hold on. You may want to do the same. For those of you who can hear me, just know that I cut them off because I don't like them as much as I like you. Let me do a little microphone reboot real quick. Be right back. All right, so I shut it down. Ron, Pete, Nanda, anybody? I may have to kill Discord real quick. Sit tight just 1 second, guys. I'll be right back. After these messages, I'll be right back. A lot of you can still hear me, even when I shut it down. For whatever reason, Discord sits in the background. So let me pull that back up. Let me get over to my education room. Let me jump back into this thing. Are we good now? Can you hear me now? Jim's got me. All right. Get rid of those. Let's get a screen back up. We got the screen. Are we there? So here's the deal. If you can't hear me, kill Discord and come back, because it's not on my end if people can hear me. So if you ever can't hear me, make sure you do it. Make sure you tell me. But if people can hear me, then that means that my side's working. My side won't automatically cut you out of the equation. So guys, simulate, simulate, simulate. And then we're going to practice. And you're going to simplify in the beginning. There's that word again, simple. I'm going to hand you a plan. We're going to get it towards the end of this first hour. And it's going to have 2 trades on it. The first trade on the plan that I give you is the highest probability trend trade you could ever take. The second trade on the plan that I give you is going to be a trade that's going to be dependent on your ability to understand that first trade. Again, if you can hear me, guys. Okay, hold on. So I'm going to kill the whole class. It's going to kick everyone out. Please come back. All right. Guys, I'm going to do a full kill on Discord. I'm going to disconnect. I'm going to come back. So if you can hear me, sorry, but we're going to try and get everybody in on this thing. I'll be right back. Disconnect, disconnect. Close it down. Task manager. Close it, open it. Sorry, YouTubers. Sometimes this happens. Sometimes Discord gives us challenges. I apologize for them. I promise they're outside of my control. All right, coming back into it. You guys hear me? Can you hear me now? There I am. Awesome. You yahoos that couldn't hear me, just telling you. Some people could, some people couldn't. It's weird. Which is good because it means it's not on my end. But that reboot typically helps. So we're good. It's all right. You know what? Nobody got mauled by a grizzly bear, so I think we're okay. Let's have a little perspective, right? Yeah, it hasn't happened in a while, huh, Morgan? Good, man. Awesome. So we got the folks coming back in. Guys, you've got to know what you're looking for. You've got to know the looks that you're going to commit to. And you've got to learn them so that they become easy. And that's the second piece to becoming a confident trader ASAP. I say it at least 1,000 times a day. Well, maybe not that much. A little hyperbole there. Repetition creates recognition, guys. Doing the same thing, doing the right thing repeatedly makes it easy. There was a time in my life where I was young and flexible, and I moved to Colorado, and I wanted to be a snowboarder. So I climbed up to the top of the mountain. Well, actually, I took the chairlift, and I looked over the edge of what I thought was the scariest looking slope that I've ever seen in my life. And for those of you that know anything about skiing or snowboarding, you know that a blue run really isn't that terrifying. But if it's your first run ever, it's horrifying. And I sat at the top and I buckled my bindings and I looked over the edge, and guys, it was horrific. And then I scooted down that thing as slow as I knew how because I was petrified. Well, by the middle of the season, I would get off the ski lift at the top of this very same run. We'd spend a lot of time on this mountain. And I would go straight from chairlift and just start going down the hill, straight ahead. And I would buckle my bindings at full speed going down this hill because I had taken this run. I had done enough repetition that it was no longer intimidating, that the mountain didn't seem so steep, that the fear was no longer there. And trading's a lot like that. In the beginning, the market feels like it moves fast, and it takes a second to put all these things together. But if you keep doing it and you keep going through, fear reduction, right? Eventually you see something enough, that neighbor's dog that used to terrify you, turns out he's a big lovable puppy. So this first tab on the spreadsheet that I'm going to give you guys, this is your repetition, guys. This is getting where you want to be by doing the same thing, by taking a picture of strong triggers, by annotating that picture. This is why they're strong triggers. And doing that 20, 30 times until strong triggers become second nature. Bob. And the same is true with weak triggers and clear paths and termination conditions. And all you're doing is you're making these so familiar that it's just not difficult to piece that pattern together to find the trade to get your entries. The second tab is the client trades, over 400 pictures. I steal these from you guys daily when you do wonderful things. When the rules are met, we drop them in. And guys, this is a great study guide. Again, repetition, seeing the same thing. I've broken down the entry sequences for longs and shorts, how you go through it, where your entries go. There's some very basic management that will be handed over to you in the plan. There's ideas for more management. Because again, when it's not so scary, when you can make good decisions quickly, you're going to find ways to manage differently. You're going to start to see things a little differently. So take 1 million pictures. Take 15 pictures a day, annotated. Guys, that's 300 pictures by the end of the month. That's almost 1,000 pictures after 90 days of study. I'm going to show you where I'm at. Where are we at? End of March. I'm almost at 2,000 pictures in 2025. To give you an idea of how important I think it is to snap those pictures, and even more importantly, to get feedback, to say, hey, this is what I'm looking at, and Mark, you don't have an emotional attachment to my trade. Will you make sure that my chart read is the way it should be? So fill this thing up, guys. And then finally, there's your trade tracking sheet. That's the last one. And I think this is the one that's going to give you the most results as a brand new user. Every time you take a trade, you're going to post it in the room. You're going to commit to that. You're not going to hold off on me. You're going to show me winners, losers, and you're going to give me the opportunity to tell you what's right and wrong, what's good and bad, what was awesome and what could be done better. And if you do that, you're going to turn this into your little trade journal, and you're going to drop your pictures in here, and you can talk about advantages. But most importantly, go to that feedback section. What did Mark say about this one? And I'll give you an example. And Jim, this is for you. So Jim's like, check it out, Mark. I had odds favorable momentum, and I had a clear path, and I took the perfect entry, and they stopped me out at 12 ticks. Jim, do you remember taking this trade? So one of the things that I would say to Jim in this instance, and guys, this is how it works, is I would say, Jim, you're a rock star. Your momentum was amazing, and your path was absolutely clear, and your entry couldn't have been any better. And guys, remember that we're taking a pattern that wins 70 to 80% of the time, which means it has to lose 20 to 30% of the time. But Jim, the one thing that I can tell you on this, and when we talk about entries, you'll recognize it, is that once the market gets about 4 or 5 ticks beyond those trigger lines, once they start blowing through those trigger lines, instead of taking a 12-tick loss, you're going to know to adjust that stop to maybe 4 or 5 ticks. And on the S&P, that's a 7-tick difference. That's 87.50, 2 contracts. That's like $170 less loser that you could take on this one, because your understanding of where the market is most likely to continue, what it does is it sets you up for an understanding of where the market shouldn't go. So I can't give Jim any feedback on the entry because it's perfect, but we could have turned this 12-tick loser into maybe a 4 or 5-tick loser with a little bit of entry rule understanding. And guys, that's what you're going to get every time. So Jim's going to take that picture and he's going to take that feedback. Awesome. And he's going to put stop placement or something like that. Watch your management. Know where the market shouldn't go. And every morning, you guys need to come back and look at what we did yesterday. These are the trades I took. This is the feedback I received. What worked? What didn't work? How can I do it better? How could I embrace the advantages? Did I read my charts right? Was there a lower risk exit? Was there a higher profit potential? And we're going to do this every day, guys. So go through and fill this out, and you'll be amazed at how quickly you get to where you want to be, because the truth is everybody has a thing. Everybody has a rule that they break. Most of you, it's going to be termination conditions. some of us that have had a big losing streak stop managing effectively because we let fear override the advantages that are present. And guys, there's so many things. Because I've made every mistake known to man with this software, I can identify it and help you work through it if you just give me the opportunity by posting your pictures, and you will grow from it if you get those into the spreadsheet. So we're going to get going. Thinking you're doing the chili dog? You might be, Bob. A lot of people tend to get there. Not a lot of people study it. They think Ron just jumps in arbitrarily. There's a lot more thought that goes to it. Let's talk indicators. Do I have any newer folks in here? I see a lot of familiar names. Patterns, patterns, patterns. That's all it is. What are we looking at when we open our software, guys? First thing you're going to see is triggers. Hey, good morning, Cav. Guys, both charts have triggers, large and small. Large and small chart, large and small triggers. Small triggers are solid lines. Large triggers are dashed lines. That's all you need to know. True story. When they're green, they're going up. When they're red, they're going down. And guys, we're going to use triggers initially to define the momentum in the market. Rule number 1. You will rely on these trigger lines to know whether or not you have that clear path from rule number 2. And you're also going to use these large triggers to define your perfect entries. So know the difference between small and large. And then both charts will have areas. Essentially, they are horizontal lines that run across the chart. There are divergence highs. This is a magenta line that prints from a pivot if there's a loss of momentum. If you ever hear divergence, I want you to make it synonymous with loss of momentum. They're magenta from a high, they're cyan from a low. For you guys that aren't artsy, they're pink from a high and baby blue from a low. You're going to see red Fibonacci resistance. When the market is trending up, these horizontal lines could stop it and create a bounce. You're going to see Fibonacci support. They're the blue lines. When the market is trending down, they could stop it and create a bounce. You're going to see yellow 1-to-1s, and depending on the direction of the market, they may behave as resistance or support. And then you're going to see that squiggly midband. And these areas have a different role depending on the chart. On the large chart, this is where the large crowd makes decisions. This is where the institutions enter and exit. This is where fights happen. These are the areas that we want to break and get to the other side of on a large chart. On a small chart, we're going to use these areas because they can create a bounce to create that bounce that we look for in the direction of the trend. And we're gonna see exactly how to use these indicators. And we're going to do it with only 3 rules. And we're going to do it with only 2 charts. And guys, focus on simple. That's what's going to get you where you want to be. So, everything begins on the large chart. The big chart, the slow moving chart, the hard to see change on chart, guys. And we have to have strong triggers because that's where we get our advantage of momentum. So, on the large chart, the first thing you're going to notice is that the background seems to change colors. It goes from red to green, green to red, happens all day long. If the background on your large chart behind the first bar is green, you're in an uptrend. And it doesn't mean jump in and buy the market. What it means is that you're looking for your rules to be met for long trades, to go up with the trend. If the background is red, it's a downtrend, same thing. Looking for rules to be met to go down with a market that has shown you that it's going down. The only way that you could ever have strong triggers in an uptrend or a downtrend is if the trigger lines match the color of the background. So in an uptrend, both small and large triggers must be green as well. And in a downtrend, both small and large triggers must be red as well. And if the colors don't match, you don't have strong triggers. Rule number 1's not met. It's okay to sit on your hands and do nothing. Strong triggers, the pattern that we're describing that provides an edge, means that in an uptrend, your small triggers have broken up, above, and away from large triggers. They have created space between the two. I want you to picture scissors that have opened up and are ready to cut. Shark about to breach and get a baby seal, right? This separation between small and large is strong triggers. When the small triggers break below and away from the large triggers, when the space is created, dive bomber, I guess, eagle swooping down to get a fish. Guys, that separation, that space between the two, those open scissors, that is strong triggers. And every time you see strong triggers, I want you to say to yourself, the odds are favorable for the market to continue in the direction of the trend. Odds favorable momentum, that's strong triggers. OFM, you're going to see it on the charts. Guys, odds favorable pushes a market. Strong triggers can break key areas. Odds favorable momentum sometimes will cover some of the mistakes or even assist the exceptions that you guys may make to your rules. So strong triggers, it's not difficult to recognize. Let's find a large chart. What do you say? The larger down, the smaller up. Guys, you don't have strong triggers. That's a small chart though. Let's go to the big chart. They're just below. You did in fact have strength. This is strength. And that is strength. And it's the same no matter what. Strength is always strength. But strength doesn't last. Strength goes away. Momentum subsides. And when your small triggers work their way inside of the large triggers, we call this a weakening of the large triggers. And when you have weak triggers, anything could happen up or down. So odds favorable, anything could happen. Strong, weak, guys, the language will let you know that you're in a good spot. This is when bigger retracements happen from key areas, middle of nowhere. So if we go through and we look at it again, this is the S&P. You'll see that strong triggers pushes a market, and as the smalls begin to return, momentum is waning, and then right into a key area, sure enough, there's a giant bounce. Strong triggers can push up, break areas, smalls begin to return, a little more retracement. Weakness from a low, that's where your bottom happened, right? Weakness from a high, that's where the reversal came from. And it's not a coincidence that it came right from a key Fibonacci area. So can you guys give me a why? Strong triggers set the tone, push the market, can break areas, cover mistakes. Weak triggers, if you're a brand new user, they should be avoided like the plague. There is no advantage in weak triggers. Awesome. Once we have the advantage of momentum, ladies and gentlemen, we're going to make sure that there's not a brick wall in the way. We're going to make sure that we're not running head first into a wall, into trouble, which means that there can't be any termination conditions. Termination conditions, false, is going to give you room to targets. We're going to just call it a clear path. You can even put CP on your chart if you want. Less is more. So a termination condition is a Fibonacci-based indicator that may reverse the market, that could create an untradeable bounce, that could break, that could reverse the market. Guys, it's a horizontal line on your large chart where the large crowd is making decisions, where the men and women who control the movement of the market may enter, may exit, may fight, may just blow right through. You will never know what the reaction is going to be. You'll never know what they want to do. They don't ever send out a memo. It's kind of hush-hush. So in order to identify a termination condition, we're going to let them get there. We're going to let the large crowd, those dynamic Renko bars, we're going to let them reach resistance. We're going to let them get to support. Until I get to support, man, support is a target. It is not a termination. But once price reaches an area, once price reaches a horizontal line, decisions are going to be made. There's 4 potential decisions every time price reaches an area. The first one is that it will break. And they break all day long, or we'd be caught in a range. The second decision that could be made is there could be a big, ugly, untradeable bounce that pulls you out of any position. The third potential is that there is a fight between buyers and sellers that creates this seismograph effect right at the area, making it untradeable. Or the final is that area could actually reverse the market. The decisions made by the opposing force could be so impactful that your large triggers go from green to red, or that your large triggers go from red to green. And guys, if you hit a termination condition, if you reach one of these lines and it reverses the market, what happens is we call it a strong top or bottom. That is rule number one for the second trade on your plan. So know that it exists. So the recipe to make sure that you're staying out of trouble: let price reach the area, let price reach resistance or support, and then just simply say, where are my triggers? Are my triggers still below resistance? If they are, it's a termination condition. It could bounce, break, fight, it could reverse. Price reaches support, all you have to do is say, where are my triggers? If the triggers remain above, it could break, bounce, fight, reverse. You'll never know what the reaction's going to be. But with a little bit of study, you're going to realize price reaches resistance, the triggers don't break, there's a big untradeable bounce. Price comes back and retests it, and retests a divergence high. That's where your reversal comes from. Now it's one of those strong tops. And check this out. I think this is amazing. So on a large chart, it's a very slow moving chart. It's hard to see change. Look at the reaction of the market at the key area. That's the fight. That's the buyers and sellers trying to figure out who's going to win. And notice that it happens at the next area. And then you can see there's more of that indecision right at the same area. And there's a big bounce right off the bottom area. These areas are where decisions are made and fights happen. And if you just scroll along, that tail is smaller chart movement. It happens at this fib. It happens at these one-to-ones. We see it at this fib, at that fib. We see bounces and indecision. We see reversals. So guys, give me a Y in the room if you're okay with me. Look at that. And now we're right at Fibonacci support with weak triggers, and the market is working a little bit. Guys, this is the one that is the most broken rule, because this one requires a level of patience, because you never know what the reaction is going to be. So as price reaches that area, price reaches Fibonacci resistance, you say in your loudest, proudest voice, where are my triggers? Oh my gosh, they're still below resistance. I choose to do nothing and wait for the reaction. I choose to sit on my hands and see if it breaks or reverses here. And if it's going to break, it's going to look like this, guys. It's just going to keep going north. And this happens a lot, typically with momentum. But an area isn't considered broken. Rule number 2 is not considered met until both the small triggers and the large triggers, both lines of each, make it above that area of resistance. Once they get above that area of resistance, you'll see that resistance behaves as support. And your path is clear, and it will remain clear until you reach the next area. So when the small and large get below support, live market examples, guys, look how they pull back and test it as resistance. Look how as they start to go through, they come back to it. Look how they break through and they come back and test it as resistance. Does everybody see that? Guys, this is one of those things that happen all the time. Let it break. They almost always retest. That's where we're going to find our opportunities. Once you know the difference between the two, once you can identify a termination condition, learn the language, price reaches an area, where are my triggers, and then once you can identify a clear path, small and large are above trouble, and I haven't reached the next area, with that momentum, let's look for an entry. It sets you up for the second trade. The second trade is what we call a 50-50 look. That just simply is a description of where the triggers are at the moment. When your small triggers have broken through the area, smashed through the area, 3 to 4 points above that fib, but your large triggers are kind of lollygagging behind, they haven't made it above resistance yet, as long as there is odds favorable momentum, that fib has the potential to break. If you take a trade, and you can, I'm going to give you a plan to do it, You have to understand that your path isn't clear. You have to say to yourself out loud, this is only the potential. I may have to manage a little more assertively. And by recognizing advantages, you're going to say, without a clear path, I sure better have a lot of momentum on both charts. I better have a low risk entry. So you're going to piece it all together, guys. Same thing going down. First, it's a termination. It's always a termination when price reaches an area. We just don't know how long it's going to last. Then it has the potential to break. Trades can be taken. They must be managed. And then it's a clear path. And it remains a clear path until you reach the next area. So there's going to be times when your path isn't clear because the areas are stacked a bit. And this is 90% of your day. 90% of your day is reading indicators, waiting for advantages. And when those advantages come to be, that's when we're taking trades. And it's okay to do nothing. It's all right to do nothing. Actually, it's pretty encouraged to do nothing. The people that are the absolute best at doing nothing are the people that end up where they want to be the fastest typically. Guys, the futures markets, they exchange trillions every day, billions every hour. You don't have to be in every move. You don't have to be the first one in. You don't have to be the last one out. Guys, if you can find a way to capture a little bit, a couple times a day, in between the areas with momentum, it only takes $400 a day to put you in a six-figure income based on your trading. That's it. Wait for the best. So guys, that's termination conditions on the large chart. If price reaches an area, let the triggers break for the path to be clear. And if they're not, wait. This one has the potential to break. Does everybody see it? Smalls below the large. I have momentum. Smalls are through, large are not. That fib has the potential to break. If I choose to take a trade, I have to understand that it's only potential. I have to understand that my path isn't clear. I may have to manage assertively. Let's talk about small chart, guys. Small chart shows change that you can't see on the large chart. This is a good example right here. If I put a box around the most current bar on that large chart and I open my small chart, all of these bars are inside of that one bar. From the very bottom, you see the beginning of a retracement. And of course that bar is growing, so is my box. But this is the refinement process, guys. This is the small chart showing you some change that you can't see on the large chart. There's one termination condition that's true on the small chart. Actually, it's the only termination condition that's true on the small chart. And it relies on the small chart to give you a heads up when the large chart's changing, but you just can't see it yet. 3 divergences in the same price range may terminate a trend. 3 cyan lines off a pivot from a low. 3 magenta lines off of pivots from a high. This look is the only time I won't take a high probability trend trade when this chart is perfect, guys. And what they're doing is they're saying, hey, I know you see a lot of momentum on this chart, but we've lost it 3 times over here. That's a pretty good indication that things may push higher. All right. Rule number 1, strong triggers. You've got to learn this one. This is probably going to be the most important rule to you as a trader. A market that is difficult to stop. Rule number 2, giving you a clear path. Brick walls stop momentum every now and then. So making sure that there's nothing in the way. And guys, when you have momentum and path, you have everything that you need to build a plan. When you have momentum and path, you are a loaded down semi with a tailwind going downhill. And there is nothing in the way to stop you. So we're going to go to that smaller, faster chart and define our entry. And your entry is precise. And the rules for entry say that you're going to use a limit order to buy or sell a pullback at an area inside of triggers. Paul, this is going to be a good lesson for you today. Jim, this is going to be a good lesson for you today, just a little refresher. We're going to use a limit order to buy or sell a pullback in an area inside of triggers. We're going to use a limit order. Right at a fib, at a mid-band, or a yellow 1-to-1 on that smaller, faster chart. Guys, we're about to define where the small crowd is most likely to fail. But the key is one, that you have an area because areas create bounces. But two, that those areas are inside of triggers. Because I want you to see this phenomenon that happens every day. And we'll just do it like this. So I want you to believe it. Price accelerates away from large triggers, and then it pulls back to the large triggers. And price gets all the way down here, and it pulls back to the large triggers. And it pulls back to the large triggers, and it pulls back, and it pulls back, and it pulls back, and it pulls back. Guys, price returns to the large triggers, whether it's a large chart or a small chart. So by having your areas inside of triggers, you have an area, something bouncy, right where the market is most likely to retrace. So your entry chart will have, Lonnie, you don't even have to tell me you need feedback, brother. I'm going to give you feedback on everything you post. Your entry chart has large triggers and synthetic triggers. It has 5-1 large triggers. You're going to use these versus the small triggers to define momentum. And it also has the 13-2 large triggers because price tends to return to the large triggers. So from the highest point of your large to synthetic or synthetic to large, this big white box shows you exactly where this retracement is most likely to go, where all those down bars are most likely to go. So you're going to use this concept to be able to define the retracement zone. And if you allow the large and synthetic to be one on top of each other, you get what we call favorable large triggers. And favorable large triggers means that the large and the synthetic, the retracement zones, are one on top of the other, creating a much smaller area where the market may retrace. By having these favorable large triggers, you're going to have a smaller window of opportunity, a smaller point where the market is most likely to continue. This is going to increase accuracy quite a bit. So we're going to define an entry. And we're going to start with the rules being met on the large chart. Because if those advantages aren't in play, why are we looking for an entry? So once I have odds favorable momentum, in this case it's to the upside, I have a clear path to the upside, everything is trending up, I'm going to look at my smaller, faster chart and I'm going to say, all right, I've got a mid band, I see a fib there, there's some yellow 1-to-1s, my triggers are here, where's my entry? Well, we don't have it yet. We need the small crowd to fight. We need a reversal bar. The first down bar after all of those up bars. And once you get the reversal bar, you're going to define, using large and synthetic triggers, where the retracement is most likely to go, where that fight is most likely to push down. And it's going to be somewhere from the top of those triggers to the bottom of those triggers. And you have to understand, every time the market retraces, this is the most likely zone for that retracement. You can define it. You'll recognize it in a fraction of a second. The tighter they are one on top of each other, the smaller this little zone becomes. This is going to help with accuracy. And once you identify the trigger lines and you know where the market may return, you're going to need an area inside of those triggers. Fibs, mid-bands, or yellow 1-to-1s. And notice that inside is all caps, because this is an important thing. We know where the market may retrace. Now you're defining where it may bounce, where it may continue with that trend. And that's going to be from one of those fibs, mid-bands, or yellow 1-to-1s inside of triggers. You have just created your zone, your window of opportunity, where the market is most likely to continue, where the small crowd is most likely to fail. Your job is to activate a limit order, 2 ticks above the highest point of support inside of triggers. If it were a short trade, 2 ticks below the lowest point of resistance inside of triggers. This is where the market is most likely to bounce. You've done all you can do at this point. You've identified your advantages. You've activated your limit order. And if they come and get you, if the market blesses you with an entry, you are long. You're in a long position with momentum, with a clear path, with an entry area. You're in a long position that typically wins 70 to 80% of the time. Guys, this is what you have to learn. You need to be able to get into the market where the market is most likely to continue. So in an uptrend, first the reversal bar, not the entry. Define the retracement zone. Trigger lines, not the entry. Find the areas within. Fibs, midband, yellow 1-to-1s. Create your window of opportunity. That blue shaded box shows where the market is most likely to continue. And notice that it's not 100% accurate. It's a range. But because of the advantages on the large chart, you're going to activate a limit order 2 ticks above it. You will not trip over pennies to save a couple dollars, guys. And because you know where the retracement is most likely to go, because you know where the bounce is most likely to happen, you can identify things that aren't a part of your entry. You can identify where your edge is gone. So in a long trade, below the trigger lines is what we're going to call the wrong side of the triggers. And once you're on the wrong side of the triggers, you don't know if, when, or where that market is going to bounce to the upside. Your advantage is gone. It's lost. In a downtrend, wait for the reversal bar, not your entry. Define the retracement zone through the large and synthetic triggers, not your entry. Find the areas within. This is where the market is most likely to continue. You're going to activate a limit order 2 ticks below it. And you're going to understand that anything on the wrong side of the triggers is where your advantage is gone, where rule number 3 is no longer in play, where the edge is no longer present. And you're going to use that idea for management initially. So Jim, this is the picture that I was thinking of when I looked at your picture. So guys, your initial stops are going to be placed 4 to 5 ticks beyond the triggers, because once it gets further than that, the market will have gone beyond the areas, beyond the triggers, and now they're out in space. And they're literally where the market should not go. And it's better to accept that, to take that small loss and just wait for the next trade. One of the things people have is your ATM strategy. And the Nexgen has all of these: 12 tick stop, 12 tick stop, 12 tick stop. And people believe that 12 tick stop is your stop, that that's where the stop goes, but it's not. That 12 ticks is going to give you reaction time. That 12 ticks gives you enough time to put your stop where the market should not go. And guys, all we're doing is we're learning this one pattern. This pattern, this description of a pattern that has been proven to win more than it loses. And it all starts with momentum, strong triggers, and then you need a path that is clear. Price has not reached the next area. We're north of the resistance, and then we're done with the large chart. And can you guys see where my little pointer is? This is where the market is trading when you're making the decision to take a trade. And this is why rule number 3 creates such an advantage, because you wait for the reversal bar. That's right at the top of the bar. And you identify your areas inside of triggers, and this is where you're entering. So even though this has maybe $80 worth of profit potential, the correct entry has almost 300. And if your stop goes where the market shouldn't, waiting for the pullback to the area inside of triggers creates the least amount of risk. It gives you the absolute highest profit potential. And you can go back and study this. You guys see that tail? That tail, from top to bottom, this is the retracement. You're going to be able to pinpoint where that tail is most likely to form. So this is going to be your study tool. Anytime I have momentum and the potential to break, at least, circle a tail. Does everybody see how the potential didn't follow through down here? I have momentum and the potential to break. Circle a tail. And then let's go to the small chart and see what it looked like. This one didn't quite make the midband. That might have been a hard one. Maybe you didn't get it. Back it up a little bit. Where'd that other tail go? Directly to resistance inside of those triggers, guys. This is your pattern. This is the one that repeats itself every day. Are there any questions about the high probability trend trade? This is how you're going to study it. Guys, your large chart goes back 10 days. Every time you see momentum and at least the potential to break, circle a tail. There's some still circled from yesterday. Go back and see if it fit the rules to give you an entry that typically wins more than it loses. That's all we're doing, guys. It's just patterns. So this one had the potential to break, but it didn't. Do you guys remember that potential is dependent on momentum? And divergence is a loss of momentum? That's the biggest killer on the potential to break, is your small chart telling you, hey, we're losing momentum, and it takes momentum to break areas. Kind of cool, right? It all comes full circle. So how do you get to where you want to be? I'm pretty good at getting people to where they want to be. All you got to do is follow the path, guys. Chart reading. Chart reading 101. I built this to help new users because I think that it's overwhelming. How do I study? How do I study? How do I study? This is how. The goal is that you look at your large chart first, guys, that you're committed to looking at the large chart first, that you force the large chart to lead the way and don't get sucked into trades because the small chart is pretty. So once you understand momentum and path, it opens all the doors for you. So go take 25 pictures each, the way we talked about this morning. Take 25 pictures of strong triggers and weak triggers. Take the time to annotate on the chart. These are strong triggers because the colors match, because the scissors are open, because the smalls are above the large, because there's space. This is rule number 1 met. This is odds favorable momentum. Do the same thing for weak, for a clear path for terminations. And what happens, it's this little magical thing. If you create the repetition, if it's going to provide the recognition, and if you go through the process of typing that out 25 times for strong triggers, you're never going to accidentally trade without strong triggers. You might make the decision to, but it won't be because you don't know what they are. The same is true with the clear path and termination conditions. So go through this process, guys. This takes the average person less than 3 hours. But the results that you get from it are outstanding. Post them in your spreadsheet. The basic rules. Take a few minutes every morning to study them. Because you can't take this picture. You can't say smalls above large, large or wide, space means strength, rule 1 met, momentum. You can't confuse that with weakness. It's impossible. It's impossible. So I'm going to give you this. I'm also going to give you the high probability trend trade checklist. This is the highest probability, best of the best. Oh my gosh, Nexgen can't think of a better way to take this trade checklist. And it starts from a strong top or bottom, which is a no triggers through termination that reverses the market. First, it has to be a termination condition. Then it has to reverse the market. If it's not both of these things, it's not a strong top or bottom. But this is the precursor to the highest probability trend trade you could take. This is rule number 1 for the second trade that you're going to get on the plan. And then it asks you, do you have odds favorable momentum on both charts? Guys, large chart momentum is the rule. But when it's on both charts, it's even more likely to continue in the direction of the trend. Know the difference between strength and weakness. Commit to one. Make sure there's no terminations. First, you have to be able to identify a termination. And then you have to know what it means to have a clear path. And then if you look at your chart and you say to yourself, oh my gosh, this is only the potential, I've got to look for some different red flags that may keep me out of this trade. I may have to manage it assertively if I find an entry. Sets you up for the second trade. Entries at areas inside of triggers, guys. So the second page is the actual checklist. And this checklist has been studied and people have gone to great lengths to prove and disprove it. I had an engineer run it through the ringer. 400-day test following this plan right here. And it was like 82.3% or 83.2, I forget. So between 82 and 83%. Winners. Nobody's ever done worse than 70% following this truthfully, guys. So I hand this to you as a brand new user to optimize your chances of success. And I hand you this plan, the KISS plan, to optimize your chances of success with that high probability trend trade as you learn to read your indicators. And this plan is a stepping stone in your learning journey, guys. This is the first step, not the last step. This is the core. This is the foundation. This is the one that teaches you to read your indicators. And then through simulation study, class feedback, and continuous practice, you'll be empowered to craft a plan tailored to your personal goals based on your experience reading the indicators. That's an AI generated way of saying, hey, guess what? When you can recognize advantages, you'll find more ways to make money. Most people do. But there's two things you have to know before you sit down, guys. You have to know why you'll enter the trade. And it has to be because my rules are met. Which means that if my rules aren't met, I have to stay out of the market. I have to sit on my hands. I have to do nothing. No matter what happens next, I have to do nothing. Because my rules are a description of a pattern that has been proven to win more than it loses. That's all it is. That's why we write the whys on every chart that we take a picture of, because we are reinforcing that recipe of success, guys. And if you take the time to verify, to validate, to trust this pattern, there should be no reason that you don't ever enter this trade. There should be no reason that you hesitate, because you know if you take this trade 10 times, you're likely to win 7 to 8, which means you're also likely to lose 2 or 3, which means you don't get to pick which ones and just hope that they become winners. You have to take them all to get that sample. Your rules, when you believe that this wins more than it loses, your rules will eliminate a lot of the emotion that people have in trading. And then you have to know why to exit. Well, it's either going to be profit targets. For the brand new user, it's going to be predetermined profit targets probably. Or when the advantages that got you into the trade are gone. For instance, if I take a high probability trend trade and 3 divergences print in the same location on my small chart, I need to exit that trade because I no longer have a clear path. If I enter a high probability trend trade and the market goes where it shouldn't, I exit that trade because I no longer have the advantage that I needed to be in that trade. So define your entry. You will find that great entries create very manageable trades. Great entries very often produce a trade that goes in the direction very, very quickly. Great entries minimize risk. Great entries maximize profit potential. But great entries must be managed. And that's where the KISS plan gives you the management side of things, guys. I went through every scenario in my head. How can I help them manage with a little less emotion? And guys, if you ever have to go to work, tell me, we'll go through it. So let's see what you had here. You had weak triggers, but you did have a clear path. And you're on the wrong side of the triggers. So where would you have put your stop, Lonnie? You're already entering where the market shouldn't go. How do you define risk? Because with this look, it could have done this exact same thing and gone all the way up to the mid-band. How do you define risk when you're already entering where the market shouldn't go? Guys, this is the damn it, it's going without me trade. This is the I can't believe I didn't get paid all the way down trade. This is the sucks to be me, let me break some rules. Let me hope that without momentum, it pays dividends. So Lonnie, this is one of those instances where if you're going to break your rules, that's where one of those confirmation bars might be a little more advantageous for you. That's where entering on a reversal bar, so at least you have some place to put your stop. And then if it doesn't work out because you're on the wrong side of everything, at least you're not taking a huge loss. You can't just not enter a stop because you're already breaking rules. That's a recipe for suicide. Does that make sense? And then small chart lines are not termination conditions. That's your first trouble spot. Large chart lines are termination conditions. So If you were going to take it, it might have stopped you out a couple times. These are the ones that you're going to get away with every now and then. You're going to get away with arbitrarily jumping in at a mid-band, and it's going to work out for you. You're going to be like, oh my gosh, Mark was full of shit on that trigger line thing. I'm going to get in on the wrong side of the triggers all the time because it won that one time. Go back and take a look at how many times it doesn't. So Lonnie, I like the large chart. Looking for an opportunity. This is a great opportunity to use the small chart for just a little bit of confirmation. Give yourself some place to control risk. Does that make sense? Good stuff, man. I hope you have a great day at work. And again, guys, if you ever need to get out of here early, let me know. I'll always give you the chart read and go through. You're welcome. Have a great day at work. So guys, management is super if-then in the KISS plan. It is emotion free as much as it can be for new users. And it's based on 2 contracts. So you're entering the market with 2 contracts. And it's designed to help you understand and trust stop placement, as well as focus on getting paid. Those are the 2 things that you got to do as a trader. We got to put our stops in the right places, and we have to be willing to exit a position. And you'll create your own plan. It'll be based on your personal goals and your experience reading the indicators. So the KISS plan management is 100% dependent on your understanding of defining entry. And it's just if-then. So if my entry is 2 ticks below resistance inside of triggers, then my initial stop is 4 to 5 ticks beyond the triggers, because that's where my advantage is gone. That's where the market should not go. And you will know your risk before you ever take a trade. If you're following the entry rules, if you're entering on the wrong side of the triggers, you're just going to have to pick what you're willing to lose if things go south. But you will know your risk. This particular trade has $150 per contract. And that's the risk on this trade. And you're either okay with it or you're not. Everybody has different pain tolerances, guys. They really do. Some of you are like, I love my large chart. This is where my stop goes. I'm committed. Some of you are going to say, well, that's just too much. I'll give it $50 and I'll put my stop right here at resistance inside of triggers. And more often than not, it just gets hit. It's like they have cameras on you, and then it drops. Or they say, well, I'll give it $80, but I'm still going to be in the retracement zone. And sure enough, it retraces up to the top of the triggers and then drops like a Led Zeppelin. And you're just sitting there going, gosh, why did I put my stop there? So if you're not cool with the risk, you have 2 options. You can either not take the trade, or you can wait for the second part of management, which is the reversal bar. If it doesn't hit that initial stop, you're going to get that reversal bar. And that reversal bar is confirming that the market is going in the direction of momentum, that the market is going in the direction of the clear path, and then the market is bounced off the area inside a favorable large trigger. So confirmation bars come from the areas, not just arbitrary reversal bars. But once you get a reversal bar, you're going to redefine where the market should not go. And now you can put your stop 2 ticks above it. So Lonnie, in your particular trade, since you couldn't define risk because you were already outside of where you needed to be, a confirmation bar gives you 2 ticks above it. And there is a price for confirmation. And it doesn't mean that you have a winner. If you entered at the area, it means you only have $30 of risk now. But if you enter on the confirmation bar, you're still about 120. But at least now it's going in the right direction. Targets are still at $100 and $200. If it doesn't come get your new stop, let's go into the first target. And if it goes to the first target, 1 contract is automatically removed. It's off. You're out of half of your position. The funds go into your account and you are a winner. And with 1 contract remaining, you're going to move your stop to break even. You're going to take 100% of the risk off the trade after profits have been taken. You're learning how to get paid. You're learning how to protect your investment. And if it doesn't come get you break even, it's going to go to your second target. And if it goes to your second target, Guys, this is a $300 trade. And it's a $300 trade in about 4 minutes of your trading day. And if $300 is the best you do every day, I want you to see this, and you'll get this in the zip file I'm about to give you. That's a $75,000 year, but you have to be consistent. And if you win a little bit more, you can get into 6 figures pretty easy. And if you use a trade copier, you could turn that 300 into 900 in the same trade. The goal is that you do the same thing every day, that you give yourself the same advantages every day, that you take the same trades, that you follow a plan, that you leave your emotion out of it. Because after 2 losers, even the right losers, your emotions are going to kick in. If you get stopped out of a trade and then it runs, your emotions are going to kick in. So that commitment to doing the same thing over and over, guys. The most successful traders I know, their charts all look the same. And when they deviate from that plan, and I'm going to raise my hand here, as soon as I deviate from my plan, as soon as I try to be smarter than what the indicators are telling me, those are my losing days. And it happens. And just because you have a losing day doesn't mean you're a loser. It means you need to regroup. You need to go look at your pictures. You got to say, wow, did I follow my plan? And guys, that's what the second half of Classroom is going to be. The zip file that I just put in the room, the everything you need, guys, that is the chart reading 101. That's the high probability trend trade checklist. That is the KISS plan. And then the one thing that's in there, it's the PowerPoint that I use to teach every day. And then I've got this. And this is Cliff Notes, if you will. Everything that we've talked about in the last 2 hours has been condensed into 2 pages. How I teach, what the rules are, where to find them, what the indicators are, defining and breaking down the high probability trend trade into individual parts, and then how to study the pattern as a whole. Everything you need. And it's in the zip file. I just dropped it in the room, guys, so go grab it. So we've learned the rules, right? You have the ability to simulate and get feedback. You've got a plan now as you learn to build your own. Now we just have to learn the looks, guys. That's your job. You are my horses. We have made it to water. Now it's time for you to use this amazing tool that Nexgen is. So as we get into the second half of the day, we're going to go through and we're going to talk about your charts. We're going to look at them. And guys, I'm not going to beat you up. That's a bad trade. What were you thinking? What the hell? What I'm going to do is I'm going to look at your chart and I'm going to say, okay, let's take a look. Did you have momentum? You should tell me whether or not you did. Was there a clear path? Let's talk about your entry. And guys, show me not only your entry, but show me your exits, because there's some great management lessons that come through when I see the entire trade. So tell me what you saw, write your recipe, and I promise you, I'll give you everything in my arsenal. Everything that I've learned over time. If there's a way to do it better, we'll discuss it. If there's a way to read it more accurately, we'll talk about it. If there's a way to reduce risk, if there's a way to increase profit potential, we're going to cover all of it. And none of it is designed to make you feel bad about yourself. That feedback's there so you can come back and study it and do it better tomorrow. So I'm going to go take a break. Crude oil has odds favorable momentum. This fib has the potential to break. And we haven't reached the next fib. If you chose to enter somewhere in the retracement zone, if your stop was where the market shouldn't go, you might have made a little money on that trade. S&P, there's a termination condition. Price reached a divergence high, triggers didn't break, and that, ladies and gentlemen, is your big untradeable bounce. Who would have known? But Mark, the entry is perfect, but the path isn't clear. It's a lower probability scenario. And then there's another medium probability, potential to break, This time it did. All right, guys, I'm going to go take 5 minutes. When I come back, we're going to go through your charts. We're going to talk about what you did, what you saw, what you felt, what scared you, what made you confident, and I'm just going to give you everything I got. I see somebody sent me a bunch of messages in Discord. I'll check those too while I'm on break. I'll be back in about 5, guys. Post them if you got them. Well, here we go. Second hour, second half. Look at that termination condition. There's your reversal. There's your potential to break. There's your pullback to an area of resistance inside of triggers. There's your new Corvette. Nice job, everybody. I'm going to scroll up to the very top of the room. We're going to start looking at some of the pictures that people posted. And Jim, we did this one, but we're going to do it again real quick just for the sake of now that we know all the rules. The momentum is there. The path is clear. Whoops. I remember when this one set up yesterday. I think we took it in the room even. The entry is ideal, and the only thing, and I know that we've already got it, does everybody see how once you're 4 or 5 ticks beyond those trigger lines, there's just no telling. There's too many options where the market may go. Just a little smaller loss on that one was possible, but it's a great trade. And Jim, I would take and lose that trade with you every time, and we would go have a beer and say, that was the perfect trade. Let's do it again if it sets up. Nicely done. All right. Odds favorable on the large chart. We're going to go, Joel's going to checklist this for us. We're going to see if he's following a checklist. Backup price bar clears the area on the 13.2. It did. I think that's that one. Backup price bar clears the area on the 5.1. It did. Enter with a buy market. Perfect execution, Joel, on the bottom one. And then this one just turns into a trend trade. Finishes the move up to the fib. Picture perfect, Joel. Couldn't have done either of those any better. Odds favorable, clear path. Enter once it gets below. That's that chili dog. And then that one's not quite an area inside of triggers. Didn't even get close, to be honest with you. So the first one, the chili dog, I got you 100%. The second one, there just wasn't an entry. It just didn't get you there. All right, chili dog. Joel, is that really odds favorable momentum? Not so much, right? Smalls are inside at the bottom of the large triggers. No, that's just getting excited, I think. But let's celebrate the other side of it. Everything is pointed up and there is nothing in the way, right? So Joel, tiebreaker, right? Everything says up and there's nothing in the way. Both charts say up with absolutely nothing in the way. You look for an opportunity to snag a little there. I like it. Just because that's a no doesn't mean you're grounded. It means you say to yourself, oh shit, this isn't perfect. Let me look for change. Let me make sure that I don't try to hold through things. Does that make sense? Good look, Joel. Odds favorable, back clears, giddy up. Perfect. Perfect again. Nicely done, Joel. Is that trade easier for your brain? It tends to be for a lot of people. I like it. You'll find your way, right? We all do. Great job, Joel. And guys, that's what we call a chili dog trade. And that was created by Ron C. in the room here. And it is one of the most imitated non-next-gen trades you're ever going to see. All right, Pete. And guys, Pete's been doing this a while. He's going to have a little different approach. Pete says, look at the strong top. It's got divergence. My trigger's rolled, and it's not even 50-50, Pete. It's not even close to 50-50. It is everything above Fibonacci support. It is price doesn't go through. Absolutely, Joel. All the triggers are above. And that's what all this nonsense is. So Pete says, well, that's not my best look. Let me let it get it to the other side of it. Let me get to the other side of the decision-making process. And I still know it's not a clear path. So let me make quick profits on the way down. And then it turns into the medium probability trend trade. And you make more. Pete, great trading, man. Directly into termination conditions. Same thing here. Right into the termination condition. But because of the momentum, you're able to make a little money. And then it turns into the trend trade, and I guess you missed it. So you get in on the way down, and it goes to the next fib. Jump the fudge in to finish the trend. Nice job, Pete. Great trading. And guys, that's a great example of how when you start looking at your charts and you're like, I have this advantage, I have that advantage, I have these advantages, I have all these things going for me, but maybe there's something not right, you can make the decision to take the trade. You can decide, I like my odds. I'll manage assertively, and that's exactly what Pete has gotten so good at. All right, Bob. I've seen this pattern before. Termination condition, huge bounce, and then Bob, are you in here, Bob? That's a sexy strong top, Bob. Price reached the fib, none of the triggers broke. Large triggers couldn't even roll up to have to reverse. I love this look. And then it creates the momentum, gets below, and you take the chili dog. You jump in and jump out. Nothing but momentum. Easy trade. Momentum and path, ladies and gentlemen. Momentum and path. Really well done. And then same thing. Termination. Odds favorable. So if you're taking the chili dog, Bob, there's no such thing as a 50. Every chili dog is going to be a 50-50. Don't even bother. Talk about price clear and divergence. Talk about your clear path. Straight to the fib. Nicely done. And then it happens again. And this is the momentum trade. So this particular trade over on the other side, your second trade, Bob, with all that momentum and path, this is the momentum trade that Nexgen teaches, where it breaks through the fib and just snaps right back to it. And just really done well. Really done well. And the one thing that I want newer users to recognize here is the large charts leading the way. When you have momentum and clear path, you'll find a way to capitalize. And here's a great example, guys. Wrong side of the triggers, and he just leaves it alone. I don't know where it's going to stop. If it's going to stop, it might stop. Hell, who knows? Here I thought it was going to stop. It went all the way to the mid-band. Let me let everything agree again, and I'll find a way. Bob, great trading. Great trading. All right, who gets to be next? And guys, remember, if you have a question about somebody's charts, feel free to ask it. Most of you, I know your plans well enough to talk through it. The original chili dogger, ladies and gentlemen. Odds favorable. Back of price clears bar. Since we're going to run out of pictures, I'm going to talk about that. Decisions are made at areas. Decisions are made at areas. Bounces happen at areas. When you let price get away from the areas, it's not a clear path in terms of trend trades. But with that level of momentum and price away from the decision-making period, if your small chart mirrors that momentum, it's hard to stop that market. And you'll notice that on this chili dog trade, guys, base hits. Base hits. Gets on base. Because if you get on base 4 times, it's a home run, guys. Go watch Moneyball. If you've never seen Moneyball, go watch it. He gets on base. You do that enough, your account doesn't know how it got to $1,000, but it's always thankful that it did. Ron, great trade. Thank you. 50-50. Could this be a 50-50 entry? I don't know. What do your rules say, Joel? Do your rules say pull back to the area inside of triggers? That was a failed momentum trade, but it doesn't look like it made the areas. That could be on its way to creating a 50-50 trade. Your momentum trade failed, the breakthrough snapback. I mean, you could do whatever you want. I want confirmation from areas. And if my reversal bar is already at the area I expect to create a bounce, that's not the area I expect to create a bounce, especially if it dissects it. So, I don't know. I mean, if it fits your rules, it absolutely was an entry. It doesn't fit mine. All right, we've got quite a few of them from Paul. Let's see what we did here. Full bar through the trouble. Take the mid-band in a strong trending market. Paul, are you in here? This is a misunderstanding of concepts. Means strong trending market means 30 plus bars. And here's the key. Without a reversal bar. Because reversal bars are fights. Not a strong trending market. Doesn't mean 3 divergences isn't a termination. So guys, you can't decide that it's a strong trending market when it's not. And just because it worked doesn't mean it was right. 30 points? I've never heard 30 points. I've heard 30 bars, Paul. 30 large sharp bars without a reversal. Because what's it showing you? The buyers are aware, right? The buyers are present. No worries. I mean, you took it. So let's talk about the entry, though. The trend is down. The path is clear. The momentum isn't great. Guys, if price reaches Fibonacci resistance and all of the triggers are below it, it says no longs, right? Per termination conditions, if price reaches resistance and all the triggers are below, resistance is likely to stop the market. If price reaches resistance and all the triggers are below, resistance is likely to stop the market. The same is true right here. Notice that fib lines right up with the midband. These divergences have been broken. So you could use a chart read to say, okay, this is the area that's likely to stop the market. Maybe I'll give it 6 or 7 ticks to see if we continue down with that clear path. So just because I have to say it's not a strong trending market doesn't mean I can't look at why that might be a decent trade for you. All right. Smalls inside a large. Divergence. Potential to break. Some of the biggest killers for 50-50s are divergence. Small triggers are up fast. White bar off the area. So many reasons. And if I'm not mistaken, that one went up, right? Guys, divergence is the biggest killer. I want to show you kind of how the KISS plan works. So the 50-50 trade is the most lost trade. This is the one that more people are going to lose. Because they take them like high probability trend trades. They take them as though everything is perfect. So the 50-50 trade needs to be from a strong top or bottom. Needs odds favorable momentum on the 13-2 because if it's not strong, it's not 50-50 anyway. And then here's where we get into not sacrificing momentum on the small chart, the chart that shows change. So if the smalls are not outside the large on the 5-1, it's less likely to work. If there's divergence, it's even more less likely to work. Double whammy on a medium probability scenario. Only you can decide whether or not you want to take that trade. So Paul, we talked about it on the sidelines, right? I see you have market flow. Is there any reason you couldn't force market flow to give you a confirmation bar from the area most likely to hold when there's so much wrong? A little bit of patience, right? Sometimes it's worth paying 5 or 6 ticks for confirmation when things aren't perfect. But you have to be able to define perfect so you can recognize that it's not. Ron, odds favorable, momentum, nothing in the way, and sure enough, you find a way to capitalize. Nicely done, Ron. Same look. Momentum and path, quick profits. Momentum and path, quick profits. Same trade, same targets, same base hits, same consistent. You could set a watch to them, guys. Paul says, check it out. There's a lot of momentum here, but I'm not going to trade into a termination. One of the best pictures you can take is that I'm not taking that trade because my rules aren't met picture. Pete, strong top, absolutely. Triggers rolled, absolutely. Not at all a clear path directly into the termination condition. 100%. 100%. Price reaches a divergence low, all the triggers are above. It's a termination condition. There's no way around it, right? You entered at 45. I don't know. I don't know how you could have. I could be wrong. Well, then I'll tell you what, then it is. If it looks like it to you, then it is. I like it. You took it down to the fib with all the momentum. Great job. As I won't argue with you. It doesn't do me any good. And it may have been. It's just hard to see it after the fact. The fib's at 27. The bottom is 29. So yeah, you might have caught it somewhere up here before it hit, which is nice. Good job. I like it. Guys, remember, after the fact, sometimes it looks a little different than it did in the moment. It's okay if I'm like, dude, it was a termination. And you're like, well, when I got into it, Mark, we hadn't reached it. And I'm like, cool. I'm not going to fight you on it. Doesn't do any good. Weak top, 50-50, divergence and weak triggers. Who knows where it's going? Sit on your hands. Amen, Paul. If it could retrace all the way up here, why on earth am I going to put that much risk on a medium probability trade with weak triggers and momentum? Really nice, Paul. Great patience. Great patience. Morgan, weak top. Great odds favorable momentum. 50-50 trade. You didn't think I'd notice that there was divergence? I like it. So there was divergence. I wanted to take the trade on the way down. I love that. Pete, Paul, this is kind of what I was talking about. It's not perfect. And Morgan says, I'll let it get to where I'm hoping it's going to bounce, but I'll catch it on the way down, because then, Morgan, you can put your stop behind it, right? And then easy money right to trouble. Really well done, Morgan. I like that. Understanding it's not perfect and choosing to force confirmation. Guys, it's your right as a trader. It's your right. Strong top. 50-50, no divergence, perfect entry. You get out, divergence prints, out on the reversal bar. Set loss and went above the bar for total risk, 60 bucks. Nice. Nice trade. Great management, Morgan. I like that number there. Good job. Oh, and this is the one that we were looking at live, Pete. I was like 50-50, but it hadn't reached the next one. There's your pullback to support. Quick lesson in correct stop placement. Odds favor on the large chart, pullback to the mid band. ATM strategy had an 8-tick stop loss, didn't move it to the correct position, stopped out to the tick. 320 loss instead of what would have been an $850 winner. Man, we've all been there, Pete. We've all been there, 100%. I like that you took this trade, though, because I remember when it set up live, we were talking in the class. I was like, guys, it's 50-50. They hadn't touched the next fib yet. That's hard for new users to recognize. That looks like termination conditions all day. That's an amazing look. And they do. Well, and this goes back to Morgan. And everybody, sorry, this is where my brain says, hey, turn it into a lesson. Reversal bar prints, right? And every day we say, just define where the market could retrace. Just define where that retracement's likely to go. Define where the bounce is likely to happen. And it's the words likely, I think, that make it so important. The market could go to the bottom of the triggers and still continue off. And Pete knows that, and sometimes you just can't get your stop in the right spot soon enough. It's a great trade with the wrong result for as great as the trade was. Good job, Pete. Better Dad. 50-50. Strong top, for sure. And I like it. Clear path, no. The one-to-ones are in the way, but they have the potential to break. Pete, about 3 times a month maybe, I get stopped out right in an area inside of favorable large triggers, and I'm like, what the hell was I thinking? Because it's usually second contract, and I'm like, oh, that's a good stop. No, it's not a good stop. You got to have those brain farts every now and then, because brain farts kind of reinforce the lessons. So guys, large chart is perfect. Strong top, best momentum, potential to break. And Better Dad says, check it out, Mark. I know it's a 50-50 and it has 2 divergences, but I'm going to take it. And I'm going to get in on the wrong side. I am going to disagree, Better Dad. You didn't wait for the confirmation bar, because your confirmation bar wasn't done printing until right here. Does that make sense? Yeah, you hoped it would be a down bar. One of the things some people will do is the bottom of this bar is the midpoint of this bar, and sometimes people will put their entry just below that midpoint, because then it's at least created half a bar on the way down. You're trading from divergence, which is in an area. But I want to show you a cool pattern, and you'll like this. Do you recognize this look here as a pivot stop out? Did you notice that above it, it created a pivot stop out? This is a pattern. This is a pattern that you can go back and study it. We used to call this the Pineski because Paul started noticing it and trading it. And let's see if we can find it real quick. One of the things, well, there it is right there. There's a pivot stop out above. Look at this. Whoops. Do you see how they took out the previous pivot by a couple ticks, Better Dad? Pivot stop out up top. And it may not hold because it's a termination, but that's a very, very real pattern. We'll see if we can find another one. And it doesn't always happen. Pivot stop out up top. Where did it push down to? It took out the previous pivot. Pivot stop out on the bottom. And that one just went through because it had odds favorable momentum. But you'll see this a lot. You'll see these pivot stop outs take out pivot stop outs. So you can almost use that as, I'm going to go back to your picture. You can almost use that. Large chart is screaming from a great top. I absolutely love this. But because of the pivot stop out here, I'm going to look for my entry somewhere up by that previous divergence high. Made your lunch money? I like it. 2 scrambled, 1 Cadbury. Thank you, Easter Bunny. Bonk, bonk. Have a great afternoon, Ron. We'll see you tomorrow. So, Better Dad, you are actually onto a pretty cool pattern and you didn't even recognize it. If I have a pivot stop out below me, I typically wait for my entries. I'm a little more patient for it to get up closer and take out the previous pivot. And then if I get a confirmation bar from the area, first profits right above trouble, second profits right here. After Nexgen Yoda gave me tips on trailing stop loss, I think I try to trail stop loss with this trigger line when separation occurs from price bars. So this is the one, as long as you don't get a reversal bar up, Better Dad, it's going down. Move too quick for you on this one, otherwise you would have placed profit target 2. Playing with the NASDAQ to see if I can get my head around it. All the action helps you stay focused. Cool. Can I give you a NASDAQ tip, Better Dad? I didn't even notice that this was NASDAQ. Because I'm just looking at patterns. All right, I'm going to give you a NASDAQ tip. There's 2 things that everyone forgets. This is a 34. This is 3 times bigger than the large chart on crude oil or the S&P or the RTY or the Dow. This is a 13.2. This is 3 times bigger than the entry charts on crude oil, ES, RTY, Dow, which means that these small triggers are large chart small triggers on every other chart. So one of the things you can do in the NASDAQ, see if I can unhide this column. If you're gonna play on the NASDAQ, there's 2 ways to take a trend trade, Better Dad. And the first thing is that the rules are met on the large chart. I can't stress that enough. The NASDAQ is notorious for overrun and fluctuation. And if you're not following rules, it typically punishes you pretty good. But if I pull back to my area inside of triggers and the small triggers are less than a full bar away, remember this is a 13.2 chart. I don't fight them. I wait for the close on the correct side of the triggers. I get to the other side of the momentum indicator. And then if I pull back to areas inside of triggers and the small triggers are above my reversal bar marker, think gap theory, I'll enter at the area because these trigger lines very often behave as support or resistance. And that's one of the things that you can use as a NASDAQ trader. See how it blew right through the midband? And it overruns those triggers a little bit? I sure will. And if you look at the spreadsheet that I gave you, if you have it, highlight the A, B, C, D. D is hidden. Right click and unhide it. And here's some NASDAQ thoughts. I'll leave those exposed now. So on this particular trade, instead of hoping, your entry, your best chance of success comes from right here. And notice how it doesn't change direction until it gets on the other side, and it doesn't change direction until it gets on the other side. So NASDAQ's a little different animal, but that's one of the tips that helps a lot on NASDAQ entries. And there's the picture for you. So if you go back and study that, and they are on the spreadsheet, that one says perfect NASDAQ entry. This is Gino. Gets in with the close on the other side of the triggers instead of fighting them. And because the large chart rules are met, it makes for a pretty easy trade. This one says wait for close. So as it got to the areas, the small triggers were less than a bar away. You never get that close. And it's a great way to avoid losers on the NASDAQ. I blew out probably 15 accounts learning that lesson. And then finally I went back and took my own advice and I started looking at the pictures and figuring out what went wrong. Good stuff. Be patient on the NASDAQ. Learn it before you try to trade it live for sure. Joel, odds favorable, clear path. Almost made it to the area inside of triggers from a strong bottom. That was probably your trade. That would be one of those ones where I hope I get it, but I'm not sure if I would. Be like, ah, here it comes. Dag nabbit. Great chart read, Joel. Josh. Josh is a NASDAQ trader. Odds favorable? Yeah. Clear path? Faux show. Got in at the mid-band inside of favorable large triggers. Stop kept you safe. And then easy money. Nice trade, Josh. Nice trade. So same thing is true here, and this might be the same trade. If these are a full bar away, area all day long. But if they're sneaking up in less than a full bar, I love the close. It's almost the same entry every time. And look at this one when it pulls back to the mid-band. See how they're full bar away? Sucks right back to them. There's kind of a good two different entries on the NASDAQ look. Because if it is going to behave as support, you've got time to manage. So, and it's the same picture that I just posted in the room. Do you see how your small triggers were a full bar away? Go at the area. And then here, they're not a full bar away. Close on correct side of triggers. Yeah, no worries. I'll give you this one if you guys want to put in your spreadsheet. So Better Dad, there's a good example of both sides of the coin there. Nice one, Josh. Great trade, though. All right, that's all our pictures. It is 11 in the AM, guys. Let's do this picture real quick. Those of you that have been in my class for a while have seen this picture 100 times. Watch this. We're going to tack it onto the one that we took maybe yesterday or day before. You guys want to talk about patterns? Price reaches resistance, retraces all the way back to mid-band support areas, goes and retests resistance, creates a pivot stop out. 2 out of 3 reversed. Guys, this is from 2021. This is from yesterday on crude oil. This is the S&P this morning. When I talk about patterns, guys, this is what I mean. Same thing every day. You just got to learn them. All right, Joel. Fib should hold. How come? Because of the odds favorable momentum against it? So Joel, by the same reasoning, that fib should have held, right? Because of the unfinished business? Does that make sense, Joel? Pivot from nowhere, pulls back to the fib. Well, it has to go because of unfinished business. I don't see any entries there. How come? Because you're not going to fight odds favorable momentum. I hope. So be careful, guys. Consistency is key. And stop creating expectations for the market. It doesn't care. Pivot from nowhere. This is more likely to hold. I agree 100%. Large triggers are above the reversal bar marker. The gap theory is in play 100%. Joel, do you suppose there's a better way than just hoping? Maybe some triggers roll. Maybe you wait for a divergence. Maybe you wait for some indication that that market is actually going to roll and go. Because it never happened here. Something, anything, other than just deciding that a fib has to hold, right? That fib had to hold, and it didn't. Damn it. That divergence shouldn't have broken, but it did. That fib had to hold, but look how far I went past it, right? So replace that, the fib has to, it should, with my indicators say. What do your indicators say? Your indicators say the market's going down. It's going down with strength. It's going down with strength. Every indicator on both charts is down except for a blue fib. Does that make sense, Joel? And then just for grins, that was about 8:30, right? I like the pattern with the gap theory. Well, mine looks different than yours. We have different ones. I like going back and seeing. And you're an hour behind me. And that was right at 7:30, which means right at 8:30, which means I believe that's where you bought. Oh, that was market replay. Never mind. Shoot, dang it. I like the anticipation, Joel. I really do, because of the gap theory and everything. I like a little more confirmation. I like a little less fight in everything. But again, it's not what I like. It's what makes you happy. But I'm obligated to say there may have been an easier way. Better Dad, top strong? No. Price reverses. Okay, strong top here, right to the termination condition, which created a strong bottom. Odds favorable? Yes. Clear path? Kind of. Well, it was a strong top too. So divergence won't print over until this bar is done. So divergence is still in play. And that fib showed up before you ever, or after you entered. So you've got momentum, the potential to break, strong bottom. Divergence is pretty bad. Divergence is even worse. And you don't just hop in. You wait for it to start going up. And I like that. You said, and Joel, this is a great one. Man, everything says up, but I'm not going to fight it. I'm going to let things start to roll. And I like it. You let it roll, jump in, and that momentum carries you here. I like it. I like the trade better, Dad. Termination, full reversal, odds favorable. You're above this fib, and you're entering coming off of that fib. And you're letting it roll. You're getting to the good side of the triggers. You're on the strong side of the triggers. And notice that it keeps going up until you get a close on the other side. So there's that NASDAQ lesson coming into play again. You're never going to win a fight against these triggers, but if you get in on the other side, you at least have a fighting chance. Nice stuff. Oh, Joel, dead link, brother. Hey, JK. So everything is up. It has the potential to break. Not the best momentum ever. Pulls back to all the support and triggers. You get in on the way up, JK. Kind of a momentum style trade. There's the same picture. What happened? This is essentially a momentum style trade, trying to anticipate the breakout. I love it. Catching it on the way up from the areas inside of triggers. It's a big stop. It's a huge stop for this style trade. A few ticks below that fib, you're hoping holds, is usually a much better stop. JK, I like it. I'd love to know what happened with it. Or maybe we don't know yet. There was your entry. And we're dancing. We're nail biting. Do I have odds favorable momentum? Not quite. Do I have a clear path? I sure do. Did I have an area inside of triggers? Absolutely. Has it made it 4 to 5 ticks below yet? It has not. Still got a dog in the fight. All right, guys, I'm going to go take another break real quick. When I come back, I'm through all the pictures. So post them if you got them. Questions if you have them. Let's finish today strong, guys. I'll see you in a few. Joe, let's get into that last hour. Everything says up, and man, they're trying, aren't they? Not the best momentum, but they're trying. There's that pattern from resistance back to the mid-band area, creates a pivot stop out. And sure enough, guys, what are you working on right now? What's your thing? What do you need help with? If you're writing your own plan, here's a template that you can use, guys. This is the same template that I used to build the KISS plan. Joel, that's like saying you need help with food. What pattern? What pattern? So this is a good one, guys. Define your entries, take your pictures. This is a great way to build your plan. Or if you're studying a plan, this is a great way to study a plan. Kind of build your own little version of it. They're trying here, aren't they? We've seen this one before. Don't have momentum. Trend's not up. No clear path down. Guys, you're witnessing the fight between the buyers and sellers right at a key area. They know. We know where they're most likely to do this. We just have to make the choice to wait for it to be perfect, right? Because I feel like, what did that entry look like? If you took the pullback to support inside of triggers and you held it to the fib, guys, you're done. You're on the golf course. You've hit your goals, probably for 2 days. It's a $600 per contract trade. The willingness to say no when it's not perfect. You've been watching gold moving quicker than crude for 2 days? Jerry, gold moves. One of the challenges with gold, though, Jerry, is it tends to be a little temperamental. Gold tends to, I'll open up gold. There's a lot of overrun in gold. Gold is like baby NASDAQ. It's like, you know, the bulldog from Looney Tunes and the little dog that jumps over his shoulder. Did you post a picture? Did I miss yours, Jerry? I'm sorry. Oh, not here. Okay. Whew. Okay, I got you. Why aren't you posting them in here? So, like, here's gold. A lot of crazy sometimes. That chili dog trade that people take, gold tends to stop you out. All right, Alex. Mr. Crazy Charts. I love it. Is that no termination conditions on the large chart, Alex? I want to make sure I'm reading it right. Cool. So you do, excuse me, you do have a divergence line here. Your small triggers are through. Your large triggers are not. So you have one of those 50-50 looks, Alex. This divergence high has the potential to break because of this momentum. But this is your warning sign. This is your, hey, let me make sure nothing goes wrong. One divergence can be problematic. I like the entry on the way back. No such thing as should hold. You can say hope it holds because of the momentum. Hope it holds because it's inside of the retracement zone. But should should never be in your vocabulary as a day trader, because Alex, if it doesn't, you're disappointed. And divergence on a 50-50 is more likely to lose. Same lesson we had yesterday. And because you took the time to say should, now you're feeling like these assholes owe you one. So let's talk about it. Large chart. Strong bottom. I love it. That is a huge advantage. Odds favorable momentum. Love it. That's a huge advantage. And once you say to yourself, Alex, this is only the potential to break. It's not broken yet. When you come over here, you start saying, well, do I still have strong triggers? They're weakening a little bit. I'm starting to sacrifice momentum when I don't have a clear path. Divergence is a loss of momentum. Don't have a clear path. And you're in 12 ticks. And this could help too, Alex. You're in 12 ticks above support, above the midband. How did you pick that as your entry? Can you help me with that? I know, uninvited guest. I like that too, Better Dad. You got up to get coffee? So you put it 12 ticks above just in case? All right. So I'm going to do what I can here. And I like that you put this. Didn't go as planned. No, you didn't miss your entry. Your entry, Alex, was support, 2 ticks above support inside of triggers, which means your entry was right here at about 37 instead of 42, which means honestly, you had the potential for $100 on this medium probability trade before it went south, and they gave you a reversal bar to put your stop behind, which means that if you're in at 37 at the rules-based entry, you've got maybe 5 ticks of risk on it instead of 9. Does that make sense? I don't think you missed, or maybe you had an entry here that you felt like you missed. So there's a couple little tweaks. What are these lines? Is that volume? These things confuse the hell out of me. So this was crude oil at 435 this morning. Let's go see what it looked like. If you don't mind, just for grins. Mine's going to look different than yours. No worries. Great look on the large chart for the potential to break. It was on replay, right on. Man. I'm trying to think how I can help you a little bit. All right, I know exactly how I can help you a little bit. I'm going to take a picture of your chart real quick. And I'm going to go through the process that I go through. So the first thing I do every time is I define momentum. Must have it. And you did it. You killed it. You understand momentum. You've got that 100%. But then I want to talk about path. And I talk about this for 3 reasons. First, if it's a termination condition, I'll simply say no trade. I don't want to trade into an area that stops the market. And this is the one, I think it got you yesterday too. If it's a 50-50, all I want to do is I want to say to myself, this is not a clear path. The line only has the potential to break. And you have to associate it's the momentum that gives it that potential. Does that make sense? It's the momentum that gives this the potential to break right here. And if you go through that process, if you identify this as a 50-50 rather than a clear path or a termination condition, you can come over here and you can say things like divergence is a loss of momentum. Smalls inside the large is a loss of momentum. And let me show you how I'm going to piece all this together. I'm going to go back to that very core that we build every morning. And if this is the recipe for a high probability trade, you're already telling yourself that your path isn't clear. And by default, with a little bit of study and practice, you're going to say, okay, if my path isn't clear, it's really imperative that I have momentum to push that market through that area that I'm hoping will break. And at the time of your entry, you were also 50-50 on this fib down here as well. So you had a 35, you had a 12-point gap that you were hoping the market would break. So when you start associating divergence with a loss of momentum, you're like, it's going away. And then weak triggers and you're like, son of a, it's going away. And you realize that the only thing you're working with, the only real advantages that you're bringing to the table on this trade is the entry area. And the entry area was perfect. You were 12 ticks above it, or 7 ticks above it maybe. But the entry area was perfect. But an entry area on its own typically isn't enough to create a winning trade. It really takes some love with the other two advantages as well. Does that make sense? I like it. I think this is one of those trades where you take quick profits. You get in at the right area. You get paid. You get to break even quickly. And since you're using the market flow, there's not a whole lot on the market flow that helps you out. Can I ask, and it's, you don't have to answer if you don't want to, do you have a written plan? Does everybody have a written plan? This is exactly what has to happen for me to take a trade. And I ask not because I think you're doing anything wrong, but in your entry rules, how does that factor in, right? How does this zone factor in? How does using market flow overlay factor in? You don't have a written plan, Alex. That is the nail in the coffin, the jumping on the grenade move. Because what it means is that you use phrases like it should. It should do this. And what you'll find, Alex, and you've been around a little bit. Have you ever seen MB in the other room, Mark Broussard? MB's been around with Nexgen for like 15 years. I had the good fortune of meeting him out at some races in Austin. There were some motorcycle races. And we just sat on the hill and watched the racers, and we talked trading for about 20 minutes. And I had been teaching for a couple years, but he had been trading with Nexgen for 15. And the one thing that he told me, and I think that it is probably the greatest thing that I've ever heard from somebody with experience, is he told me, he goes, I spun my wheels for about 4 or 5 years. 4 or 5 years, guys. Because I didn't have a written plan. I didn't have something to follow, which means that every trade that he took was It should. I think. I hope. It might, right? Instead of my rules say. So, Alex, I encourage people that don't have trading plans. I don't ever try to hold you to anything, and I certainly don't tell you how to trade. There's a path of least resistance as you find your mojo, as you get your groove. And it starts first with having a written plan. This KISS plan, based on what Nexgen users tell me, this KISS plan, I just closed it out. Most people tend to find themselves, if they follow it, in the 70 to 80% range as far as winners, which is great because it clearly defines entry and it gives you a management plan that you can work on until you can build your own. And then it has that 50-50 look. And there's a lot of factors that go into optimizing the chances of success for it. So if you keep it simple like this, a lot of people find that it's a lot easier. If you allow it to only be 3 rules initially for the high probability trend trade, and you force it to be on the 2 most basic charts, what you're doing is you're giving your brain a break. You're telling your brain, I don't want you to think about anything but the best. I want you to find momentum. I want you to define your path. And if things are kick-ass, let's go find an entry. And again, Alex, you're probably way smarter than me. Most people in this room are. You could probably look at all this and be okay with it. Me personally, this absolutely, my brain can't do it. But my brain can't do math if you throw a letter in it. So we all think differently. But I do believe simplicity, until you start really getting your groove, is a great approach to trading. And there's very little that's simple about your charts. Need a plan? So would you be interested? And you don't have to. I don't give trading advice. I never have. I never will. And I know that when people in the other room start posting pictures of their charts, it's exciting. Oh my gosh. Handy's charts. The hell is that? I don't know. I can't read that to save my life, but he can. It works for him. And he's getting the results. But if you're not getting the results, maybe simplicity. From the resources page, and you can do this yourself or Jason can do it for you, you can download the indicators and you can get that super basic workspace and start focusing on a couple good trades, right? Go back and do market replay and take that KISS plan and print it out. And when you think that you see, and this is what I really like people to do, if you're on market replay and you're like, oh my gosh, I think it's a high probability trend trade, hit pause and compare it and make sure that it actually is. And if it's not, be willing to not take it. And if it's one of those 50-50 trades, hit pause and make sure that the criteria is met. And what you'll find is that market replay isn't an exercise in trying to get paid, but rather it becomes an exercise in trying to follow rules. And when you follow rules, that's when you realize just how easy it is to get paid. Does that make sense, everybody? Learn the process that yields the results, because when you chase the results, you've eliminated the process in many cases. So there's my little study thing. And of course, keep doing what you're doing, right? Post in the room. Let's talk about it. I think right now your biggest advantage is going to come from the recognition that that's 50-50 and not a clear path. And I think without changing anything, that tiny little understanding and focus is going to change the direction of a lot of the trades you take. Good stuff. Thank you for posting, Alex. It's hard to post in this room, especially when it's a loser. I know that there is. I know that it's tough. So good stuff. What's next, guys? What do you want to talk about? Oh, absolutely. That's what we do, right? There's gold. Just, oh. Snake boogie caught in between fibs. S&P had a breakout. Termination. Odds favorable. Uh-oh. My mid-band's on the wrong side of triggers. That's not rule number 3, is it? Large chart's beautiful. Small chart says the bouncy point's on the wrong side of the retracement zone. Look at that one though. Termination, reversal, momentum. Oh, that would have been a nice one. Anybody catch this one? Or did you complicate it and overthink it? You got it? Nice, Joel. And you took it just as the jumping in? Nice, Bob. I'm telling you, once you start talking about advantages, it's kind of crazy. You'll find a way, guys. It's like Jurassic Park. Life finds a way. Just because you can doesn't mean you should. Let's do all the Jurassic Park quotes. One of my favorite Elon Musk quotes is, engineers frustrate them because they always try to optimize something that should have never been invented in the first place. And it just cracks me up because I've got some great friends that are engineers and they do it. Oh my gosh, if you go to their kitchen, their can opener has modifications to make it more efficient. Well, this can opener was good, but I changed the gear ratio and now it takes 1/3 of the effort to open a can. True story. It doesn't have to be difficult. You just have to be patient. Did you guys see the note that I posted? I think it was last night. Maybe it was 2 days ago. Guys, we're getting crazy close on the funding. And I believe next week when John Novak's back from Houston, there is going to be just the full-on assault push to do the final run of testing on the prop firm and all that good stuff. So keep your eyes open if you want to be a part of the beta testing and that last push. And just God willing, we're going to go into April with a funding company and hopefully a browser platform pretty soon too. All right, Bob. Bob said, 3 divergences, perfect termination, odds favorable, clear path. Trend trades are fun, but let it go down 8 points. And then I'll just take a 6 lot to get to the fib. And there's not a darn thing wrong with it, Bob. Not a darn thing wrong with it. Great job. I'll take 2.5 points 6 times over all day long, brother. Odds favorable, clear path, find a way. Great job, Bob. Better Dad. Can you read those numbers? It must be fun to be young. All right. Is this NASDAQ? This is NASDAQ, right, Better Dad? All right, so we're going to do a couple things. First, we're going to correct pivot stop out. Not a pivot stop out. That's a lower divergence. So let me grab a couple pictures and I'll show you exactly what I mean about that. Pivot stop outs. Let me make this bigger. So pivot is up to down, down to up. That's a pivot. Pivot on its own doesn't mean anything. It just means the market changed direction. If there's a loss of momentum at said pivot, that's where you get the divergence line. That's a loss of momentum at a pivot. It's not a termination condition. It's not a pivot stop out. It just says, hey, look, the sellers stole a little momentum from the buyers. A pivot stop out means that they came back and retested that area, that the seller said no, created divergence, and the buyer said, but we really want to go up. The sellers let them get 4 or 5 ticks above it and then just unleashed hell on them. And so here's your pivot. Here's where the buyers get stopped out. Pivot, stop out. Here's your pivot. Here's where the sellers get stopped out. Pivot, stop out. So what you had, Better Dad, was just a lower divergence. Does that make sense, everybody? Oh, for sure. Here you go. Do pow. And I'll tell you what, let me do this real quick. Guys, I've written a lot of stuff. Just little 1 to 2 minute, or a little like half page, 1 page, 2 page. There's all of them in a zip file. These are all 2-minute reads about a lot of little concepts. It's the same thing that inspired me to make the 60-second video series. That's the print version of these little itty-bitty things. Take a minute, look at them, learn something, good stuff. But let's get back to your chart. Whoops, did I close your chart? I sure did, sorry about that. So Better Dad, and that's just me. I want to get the language because this isn't a termination condition. This is only lower divergence. And then here's your NASDAQ nuance a little bit. You ready? Remember that your large chart is a 34? These pink 1-to-1s on the NASDAQ, Better Dad, termination condition all day long. Because these are from small swings. On the S&P or crude oil, they're insignificant. On a giant 34.5, those small wings are ginormous. So you traded directly into a termination condition. And where did you take it, though? You took it here, though. All right. So you had momentum directly into a mid-band. Large triggers are almost a full bar away. And because it's a bad top, mid-band's more likely to hold. Entry is not perfect. But if you were going to take this one into a mid-band from a bad top, Better Dad, why not use that reversal bar to mitigate risk? Why not use that reversal bar and put your stop behind it, redefine? Because this is a smaller loss than this. And this lets you live to fight another day, and this blows out accounts quick, especially on the NASDAQ. Does that make sense? And I know you're just learning the nuances of the NASDAQ. So, couple good lessons on this one. The first one is when a pivot comes from nowhere, mid-band is more likely to hold. I think the second one is be willing to use those reversal bars for stop placement. And you say this isn't the trade you would take, but you think you have the right look going into it. Really wide entry window, too high risk, almost 20 points, yeah. So when the risk is this big, confirmation bar. Confirmation bar helps a lot, a whole lot. But this market has been screaming to the upside. They turned from nowhere, did everything we would anticipate. Then when they get back up to trouble, that's when they kind of redecide. It's not a horrible trade. You're learning the NASDAQ a little bit. Learning the NASDAQ. Joel, this is perfect. 3 divergences, double top. Odds favorable, potential to break, no divergence, perfect entry, and it's just flawless, Joel. Great trade. Easy trade. Nicely done. All right. Divergence, lower divergence. That would be considered a strong top because the triggers didn't break. Odds favorable. Potential to break. And you take the little snapback to resistance, and that's easy money. Are these two termed clear path? So Alex, clear path is regarding whether or not you've cleared all your Fibonacci areas. You have not in this particular trade. The trade that you took here is a momentum style trade. So with the termination, with the reversal, with the momentum, when the small triggers break through Fibonacci support, you sell a little snapback right at that resistance, and it's easy money all the way down to the fib. It's a great job. I like this trade. I'd be a part of this trade all day long. Nicely done, Alex. Boaz. Momentum, clear path, perfect. Late entry, I agree, very late entry. And you just get paid, and that's okay. There's nothing wrong with getting paid. Nicely done, Boaz. Really late on the entry, though, for sure. You thought that they weren't going to get you, and they came back for you, and you just didn't believe them. Nice trade, though. Can't ever argue with making money. Great top, odds favorable. Couldn't get in soon enough. So you take it on the way down. Once again, Joel, we're starting to see this from you. Odds favorable to clear path. If they don't hit your entry, you're willing to catch it on the way down. It establishes your stop. Nicely done. Good looking trade, Joel. This is kind of becoming your little trademark there, right? When the large chart's perfect, if the small crowd can't fight all the way to the bouncy point, you'll just confirm it. I love it because it establishes risk. And as long as you get into this trade with the understanding that they may come back to that mid-band, maybe you have to take it twice. Did you guys know that sometimes you'll have to take trades twice? Even though you don't want to? Sometimes you'll take the perfect trade and it'll stop you out, but nothing's changed and you have to go again. Guys, that's kind of a normal part of trading. The one thing that you're not supposed to do is take it twice if the rules aren't met anymore, and that's where people falter a little bit on double dipping. I like it. Great stuff. You guys are awesome. Look at that. 3 divergences in the same price range. Does everybody see that? 1, 2, 3 divergences. Right at a fib. Did you know? Fun facts, guys. Fun facts. Did you know? Hold on. Let me just drag my voice so it takes a while to get there. Did you know that any 3 divergences in the same general price range usually cause major reversals? True on all time frames? Pretty cool, right? Guys, this picture is from 2021. 3 divergences right at Fibonacci resistance creates a monster move down. 3 divergences right at resistance creates a monster move down. Have I mentioned that what we do is patterns? I'm not sure if I said that. Hey, Better Dad, great job today. Remember, take it slow on the NASDAQ. Be willing to make a lot of mistakes, but really analyze what you're doing because NASDAQ has a lot of nuance to it. It really does. Good stuff today. You guys are killing it. Follow the rules. I know, right? That's it. They're there for a reason. They're there for a reason. All the divergences, right at a fib. It could still go down, right? It's not my money. If it does, it's not my money. I don't have my rules met. It's almost too easy to know whether or not your rules are met. And it's damn near impossible as a brand new user to just wait for them to be perfect. First bounce, and then you get two divergences, and none of your areas are inside of triggers, and sure enough, nothing stops it. Do you guys see that? Have we talked about that? Even with the clear path, you don't have odds favorable momentum. You don't have areas inside of triggers. 66% of your advantages were gone at that point. All right, I'm going to talk about some of my own pitfalls since you guys are done asking questions. So in my own trading, there was this baby question. When the first target's hit, it goes directly into the bank, whether the second target fails? Yeah, so Joel, show you exactly what I mean. Let's say I enter right here at 82. And at 92, one contract comes off at $100, right? So I still have one contract on. If my stop is right here at break even, it's going to hit my stop, take off the second contract. I had a $100 trade. If my stop is $100 below my entry at 72, I won 100 here, but I lost 100 here. That's a net zero trade. So once it goes in, Joel, once it goes in, it's yours. So Paul takes a short, pulls one off at $100, and that money is his, 100%. And then he takes the second one off at $200, and that's it. That's his trade. It's a $300 trade. And then he says it bounced another time off this, but 3 divergences, no reason to go again. I agree 100%. You know what's fun is you guys are going to tell me in the room, I like that, strong trending, sell the midband. That one qualifies, Paul. But do you know what the challenge is with this one, Paul? Even though it's strong trending, the rules still say don't trade into a termination condition. And that big divergence low at 54 was 100%. It's a good trade, though. That's the right usage of it, though. Nice job, Paul. And you're welcome, Joel. Thanks for asking questions. I don't know that that's a baby question. There's a lot of things that people, that I take for granted at this point, because I've been doing this for a while, that didn't make sense when I was new. Being able to sell something that you don't own. It took me a month, and probably the reason my brother is bald, trying to explain that one to me. Ticks. What's a tick? A tick is the smallest movement possible in the market. That's it. Every market has ticks, but depending on the market, there's different values, right? So when I say don't put your stop, put your stop 4 or 5 ticks, I'm not saying put your stop $50. I'm not saying put your stop $100. I'm saying put it where the market shouldn't go. You can define that using the tick. So there's things that will come into play and become a little second nature in the beginning, but I try to teach class as though absolutely nothing is obvious. That there's no terms that make sense to you, that there's nothing that you've ever seen. And if you come at it, right, with like, This is brand new. This is kindergarten. Let me forget everything I know about how awesome I am, and let me just take it easy, and let me be okay not keeping up with the Joneses. But if you do like a little terminology and the frequently asked questions, there's a lot of these things that are covered, that are talked about in the definitions: one-to-one, small swings, divergence lines. There's so much information here, but every one of us have put things together and had extra parts because we wouldn't read the instructions. So the instructions are all there, and always ask your questions, guys. I want all your questions because they turn into great lessons for everybody, and a lot of times I forget that that might be a question. There's gold. Odds favorable. Potential to break that one. Divergence prints. And it pushes all the way down to support. Triggers are way above it. Support ended up holding to the tick. And off it goes. And guys, this is one of the things about gold. So Jerry, when you're like, I've been watching gold and it's zooming, this just isn't uncommon on gold. It's not uncommon for gold to blow through an area and then continue in the trend. And I don't know why, but it seems to be a very emotional market. I don't know who's trading gold. Maybe they're over-caffeinated. But it seems to be a market that, that overruns a little bit now and then. I mean, that's an easy way to describe it, right? When you're emotional, maybe you're not as smooth as you want to be. I don't know. That's how it was described to me. Through triggers, usually to support fibs. I don't know what that means. That's when you know exactly what you're saying, but I'm not exactly sure what you mean. Fibs that it passed. Oh, so when it breaks through, resistance becomes support. All the triggers are above it. They like to retest areas a lot. Breaks above, retests. Breaks above, retests. Breaks below, retests. Okay. See, and that's understanding. Breaks above, retests. Comes off of it, hits the mid-band. Large triggers don't follow, continues up. They're all patterns, right? Come back, retest. That's good to know, though, because what you're doing, Jerry, is you're learning the patterns that tend to be unique to gold, right? That very basic high probability trend trade look, guys, it's universal. It really is, and it sets up a lot. But there's a reason that I teach on crude and the S&P, because those tend to behave the best. Those